Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.
This week on Wall Street Wrap-Up, the Federal Reserve had their scheduled interest rate meeting to see how much more we'll be paying for credit card interest to home loans. We'll tell you what they did. And it got testy yesterday for the CEO of TikTok, as the head of the Chinese app appeared at a House committee this week, and both parties were hostile to the chief executive officer. Finally, something both parties can agree on. And you heard of SVB, or signature bank failures? Well, this week, larger international banks as Credit Suisse and Deutsche Bank came under scrutiny for their solvency. One's been taken over by UBS and the other is under the microscope. I'm Andre Laborde. We've got these stories and more. It's Friday and it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up on a Friday, March the 24th. This week, the Federal Reserve had their meeting and did what exactly we thought they would do. They raised an additional 25 basis points, or 1/4%, the highest level since September of 2007. Now bringing the interest rates that the banks get from the Federal Reserve to 4.75% to 5% interest. Now, this marks for the 9th consecutive increase by Jerome Powell and the other members of the Federal Reserve, all to try to bring inflation back to their goal of a 2% per year level. But knowing what banks are charged by the Federal Reserve, what does that mean to you and me? How does this affect the average consumer? Well, the raising this week of interest rates means that everything we need that takes credit will be going up. Are you thinking about buying a new house? Well, just 1 year ago, the interest rate would have been just over 4.25%, but now it's over 6.5%. How about a new car? Well, this month the rates are just under 7%. And if you're thinking of a used car, well, that's going to be just over 11%. Many of us carry credit card amounts month over month on your Visa or your MasterCard. Well, now you're paying on average just over 20%. So with no let-up in sight and the Federal Reserve wanting to crush inflation, and don't forget, all the while dealing with a Congress and the administration that wants to keep spending more and more money, putting it into the economy. So how did our money do this week? Well, stocks ended the week by brushing off the Deutsche Bank fears. Stocks rebounded from their lows of the day and ended higher. And the Dow Jones breaks a 2-week losing streak, ending for the week higher. It was a green screen this week with all the averages up. This week, the Dow Jones Industrial Average closed today at 32,223, up almost 4% for the week. And the S&P 500 closed today at 3968. It was up 1.3% for the week. And the NASDAQ, they closed today at 11,815, up 1.6% for the week. Coming up tonight, we'll be talking about bank failures this week, the economy, where to invest your money. We'll be talking with Phil Orlando. Phil is the chief equity market strategist at Federated Hermes. How safe are the banks with SVB and signature bank failures? The state of the economy. Where is he telling his clients to invest for the rest of 2023? That's Phil Orlando. He's coming up. Well, this week, the banks, not just the small regional banks, were the topic on Wall Street. Credit Suisse, based in Switzerland, after 160 years, came under scrutiny and in the course of 36 hours this week was acquired by UBS. So just how did we get to where we are today? Well, before COVID, before the lockdowns, the U.S. economy, pre-pandemic, was a $21.7 trillion economy. The federal government and the Federal Reserve expanded their bond buying expansion and added so much money into the economy, we would end up with massive inflation. Government stimulus added over $5 trillion, and added to that, the Federal Reserve buying Treasury bonds and mortgage bonds. That added almost another $5 trillion into the economy. So with all this government money being thrown into the economy, inflation topped at its highest at 9%. And the Federal Reserve was caught in the economy not being transitory as they first thought, but a full-fledged inflation crisis. So with all this free money, banks such as SVB and Signature banks were lending money for venture capitalist companies that the government loved, such as solar companies, Green New Deal companies, and some were not even turning a profit. When interest rates were rising due to the Federal Reserve, the Treasury bonds that these banks had invested in turned to lose money because the yields were going down. So they did what banks do when they need money. They went to the government to get more. $300 billion just last week. A recent Associated Press poll taken after these bank failures found that only 10% of the American public has a great confidence in the American banking system. That's about the same percentage as those that have trust in the media and faith in politicians. And half of the public have only some confidence in how banks are run. So, if you have money in a regional bank, is it safe? And the answer is yes. Any FDIC-insured bank, each account is guaranteed up to $250,000. If you've got over that amount, you can open another account at the same bank, or you can go to another institution to open an account. Now, if you have a business with a federal ID tax number, the cumulative accounts at that bank are insured up to $250,000. Phil Orlando is the Chief Market Equity Strategist at Federated Hermes. He's here with us tonight. Hi, Phil. Welcome to Wall Street Wrap-Up.
Andre, thank you very much for having me on. It's a pleasure.
Phil, I always like reading your thoughts about the market, about the economy. And earlier this week, you had read where you thought that the Federal Reserve was probably going to be raising interest rates 25 basis points. And just like you said, this Wednesday, they raised interest rates 25 basis points. But I'm curious your thoughts. Do you think that you thought that they would do it? Do you think that they should have done it? Or do you think they should have had it at zero or maybe higher?
No, I think they reached the right decision with a 25 basis point hike. There were two sets of issues that the Fed, in my view, was grappling with. One, of course, was the Silicon Valley Bank situation, Credit Suisse, et cetera, and whether or not we were dealing with some sort of a massive banking contagion, much like we saw with the global financial crisis back in 07, 09. Just parenthetically, we do not believe that this is a repeat of the 07, 09 situation. We think we had a couple of bad actors here that banks that were poorly managed, that were more one-offs than symptomatic of some sort of a systemic problem. The other set of issues that the Federal Reserve was grappling with were the economic issues, the easy ones in a sense. And the economy's running hot, labor market's been strong, people are working, so consumer spending, retail sales have been strong, and inflation, while it certainly peaked in the middle of last year and is starting to come down, it's coming down at a much slower pace than I believe the consensus believed. So we absolutely believe that the Fed will get to their 2% target, but we're measuring that pace, that trajectory in years, not days, not weeks. So given that set of circumstances, our best guess is the Federal Reserve should have raised interest rates by a quarter point, focus on the economic issues, and sort of keep an eye on the banking issues to see whether or not this turns out to be a bigger deal than we think.
Phil, do you think that the Federal Reserve was kind of in a trick bag? Because if they kept the rate at zero and they didn't raise 25 basis points, then would Wall Street and investors be thinking that just like SVB and Signature Bank and also First Republic, possibly others, that there may be other shoes to fall for bad banks?
Yeah, Andre, that's a great point. That from an economic standpoint, what the Federal Reserve should have done was raise interest rates by a quarter point. But if the Fed came in on Wednesday and did nothing, or actually turned around and cut interest rates, then the market might have freaked out. There might have been a panic thinking, what does the Federal Reserve know that we don't know? When we were back in the 2008 situation, St. Patrick's Day of 2008, the Federal Reserve had the arranged shotgun marriage between Bear Stearns and J.P. Morgan, and we thought we had dodged a bullet at that point. But 6 months later, we got into the heart of the global financial crisis. So while we think we've dodged a bullet with SVB now, if the Fed had gone in the wrong direction in terms of monetary policy, that we might have seen some flashbacks to the global financial crisis in terms of what happened, during that period.
Phil, right now the FDIC has between maybe $125 billion to $130 billion of FDIC money, funds collected from banks in the event of a bank failure. But the Biden administration is saying that they're going to be insuring all of those, even those over any accounts over $250,000. Well, as we know, that sometimes bank failures like roaches, where you see one, there's probably going to be more. And with the Federal Reserve raising interest rates continuously, this is what kind of got Signature Bank and SVB in the problem that they had, being caught with treasuries. So if there becomes more bank failures, what's the FDIC going to do if they've already covered Signature and SVB Bank no matter what? I mean, you've got some accounts that have literally $2 billion, $3 billion in one account. So what's going to happen there?
Yeah, the cockroach theory here, Andre, is a critically important one, and the market is perceiving that if the Federal Reserve was going to come in as it did a fortnight ago and guarantee all the depositors that were working with Silicon Valley Bank, then they're going to keep coming in and doing that over and over again. I think the FDIC and the Treasury and the Federal Reserve have to come out and explain that that was a one-time offer. I think Yellen attempted to do that today. That could be why the stock market, the S&P 500, swung about 100 points over the late afternoon period, because there was a perception that perhaps there would not be this ultimate backstop forever, till the end of time. For all depositors, that we've got to get back in a situation where banks are making good decisions and are well managed. That's ultimately the reasons that the Silicon Valley Bank went under. Management did a poor job in terms of managing their lending, managing their investment portfolio, managing their deposit base, and they didn't have the proper hedges in place in terms of how to manage their portfolio in a rising interest rate environment. If the FDIC and the Treasury and the Federal Reserve are going to come in and backstop every bank every time they make a mistake, then what's to stop a bank management from managing aggressively in a very risky fashion? You've got to allow these people to go under. And I think Yellen took the first step to try to turn that psychology around today.
I think there was an economist, and I wish I remember who it was. An economist one time said, capitalism without risk is like religion without sin. It just won't work, for doing it. Well,
and I think it was Warren Buffett who said that you don't find out who's swimming naked till the tide goes out. And that's exactly what happened 2 weeks ago.
True. Do you think it was something that was odd that both Signature Bank and SVB, Silicon Valley Bank, are both regulated by the San Francisco Fed, the Federal Reserve? Do you think somebody was just asleep at the wheel there? Because both were San Francisco Federal Reserve.
So certainly the San Francisco Fed has oversight on Silicon Valley Bank. I thought that Signature Bank was an East Coast bank that was being monitored by the New York Federal Reserve.
I apologize. You're absolutely. I'm thinking of First Republic. First Republic. Thank you for correcting me. You're absolutely right. You're absolutely right. Mm-hmm. It was
I think the San Francisco Fed was to some degree asleep at the switch. What we're hearing now 2 weeks later is that they had done some analysis. They had produced some memos to file indicating that there were problems that they had identified, but for whatever reason they didn't feel it was necessary to come in and make some edicts and take some hard action to prevent this from happening.
Phil, it may be a little bit too soon at this moment, but from what I understand, the CEO of Silicon Valley Bank was also on the board of the San Francisco Federal Reserve Board. So he was kind of overseeing one of his own bank. Do you think at the moment that they're going to find anything illegal or improper with that bank or with others?
And it's also my understanding that the senior management team of Silicon Valley Bank was part of the group that was lobbying Congress to relax some of the Dodd-Frank rules. We also know that some of the senior managers at Silicon Valley Bank in the weeks prior to this crisis were selling shares into the market and taking some of their proceeds out. I think all of that has got to be part of the analysis. I think it's probably illegal, certainly unethical.
Phil, what about clawbacks? Who would be in charge? Would this be something of Congress or the FDIC that uh, executives like on Silicon Valley Bank or First Republic or Signature Bank, because of just what you just said, where all the money that had been taken out, that they would be able to claw back some of this money?
Well, President Biden was very vocal that there needs to be senior management accountability here. The senior management was terminated. There needs to be clawback on these raises and bonuses. There needs to be civil penalties. I think that's got to be all part of the process here to restore some element of confidence and trust in the public that we don't have these political games and shenanigans going on behind the scenes and that everyone's going to get off scot free with a slap on the wrist.
Well, also, and that's a good point, Phil, because let's say just take Silicon Valley Bank. What they would do is they would make the loans from many times venture capitalists or companies that really haven't had any profitability yet. They would get the money from the Federal Reserve. They would loan it to the venture capitalists with the understanding that they keep the money in the bank. Well, by keeping the money in the bank, then that looks like they've got higher creditors, more people that are, more people that are account holders, depositors, and then they would loan it out and make money. Where we talked about it earlier was that there was a problem when it came to the yields. They went underwater with that. So I'm curious if, like we were talking, is it illegal, unethical, or was just stupidity?
Well, probably D, all of the above. But
Okay.
I'm not a banking analyst, so I'm going to let Michael Barr, the vice chairman of supervision on the Federal Reserve, conduct his independent review and come up with what were the issues, where did the oversight lapse, and what sort of program do we need to put in place to ensure that this sort of thing doesn't happen again.
What about inflation, Phil? With because of this situation, interest rates this week, like we talked about earlier, they went up 25 basis points. And if the possibility of more bank failures, do you think that this will create a higher degree of inflation?
Well, the Federal Reserve thinks so. This was one of the meetings at which the Fed updates its quarterly summary of economic projections. And without getting too geeky, what the Federal Reserve did is they took their estimates for gross domestic product down and increased their estimates for inflation. So we get inflation back to the Fed's target based upon their own 2% core PCE target by the end of calendar 25 now. And we're still here in the early stages of calendar 23. So, the market perceives that, again, this inflation problem is going to disappear in an eye blink. It now looks, by the Fed's own reckoning, that we've got another, 2 or 3 years of heavy lifting to get back to where they want to be.
Is that why, Phil, that when it was released on Wednesday that the Federal Reserve was going to raise 25 basis points, and after Jay Powell was giving his press conference, I mean, the market just went south. Both all indexes, the Dow, the S&P, and the Nasdaq went straight down. Is that the reason why?
Well, so when the Fed when they released the information, the Fed started talking. Jay Powell at the press conference. The stock market initially shot up by 40 points. The S&P 500. There was a perception that this was the last hike in the rate cycle and that the Federal Reserve would start to cut interest rates aggressively, that they would cut at every meeting for the rest of the year. Looking at my Bloomberg screen, that's exactly what it said. And then over the course of the press conference, Powell said, this is not going to be the last hike. We're going to keep hiking interest rates if we need to, and we have no plan to start cutting interest rates this year. We're going to go on pause into sometime next year. It was at that point, I think, that the market turned around. The S&P from its peak for the day dropped about 100 points to where we closed, and that in conjunction with Treasury Secretary Yellen's speech in another venue, I think was the combination that sent the market lower over the last hour or so on Wednesday.
Phil, do you think that because of the circumstances that you were just talking about, that this will increase possibilities of a recession? Do you think a recession is forthcoming? Or what are your thoughts on that?
So right now we're on recession watch. And I can't tell you definitively whether it's going to be a soft landing or a hard landing, whether it's going to be a rocky landing or no landing at all, which is to say that we're just going to, skirt past all of this. But the combination of higher interest rates, the bank potential contagion situation, still elevated levels of inflation. We expect to see a couple of negative quarters of GDP somewhere in the second half of this year and the first half of next year. And depending upon the confluence of those events, we may very well, fall into recession at that point. So right now, you're looking at inverted yield curves. You're looking at the leading economic indicators being negative 11 months in a row. These are typically signals that suggest that the U.S. economy is heading in a recession. But we're going to keep an open mind here, and we're going to be data dependent in terms of, the direction that the economy is going.
Phil, what are you telling your clients? The S&P right now is about 4,000 or so. Do you think that the S&P will be falling lower? Are you telling your clients they should be more in cash, equities, both, bonds? What are your thoughts?
What we're telling them is to maintain a posture much like we had them take last year, which is to keep the defense on the field. That we think that stocks at 4,000, given the problems that we're dealing with, elevated inflation, more Fed tightening, declining corporate earnings, add the element of this banking crisis, potentially slower economic growth. We think that a combination of cash, treasuries, and equities that are focused on value, domestic, both large cap and small cap, and international, those stocks tend to be lower PE, lower beta, with much higher dividend yields. Maintaining that kind of a defensive posture, we think, will allow investors to sort of hunker down, preserve some capital, and wait for an opportunity to get more aggressive, perhaps later this year or perhaps next year.
Are there sectors that you like better than others? And also, are there sectors that you may want to stay away from right now because of what you're talking about?
So we're still staying away from the technology sector generally, and the Silicon Valley Bank issues, I think, really shone a spotlight on that. The sectors that we like are the more stable demand sectors, the ones in which consumers have to purchase goods and services regardless of how strong or how weak the economy is. So we love energy, healthcare, consumer staples, utilities. Again, those PEs tend to be lower. The betas tend to be lower. Dividend yields tend to be double what the broad market is offering. International stocks, same thing, very cheap. Dividend yields that are double that of the United States. So those are exactly the kind of places we want to be. Cash right now is a real asset class again, with a 4 to 5% yield. And treasuries have rallied pretty hard here over the last couple of weeks. And if the economy continues to decelerate in terms of economic growth or the risk of recession, treasury investors will probably do pretty well as well.
Phil, always enjoy reading your thoughts. I love talking to you, and I hope you come back.
Andre, this was a real pleasure for me. I remember doing Louis Rukeyser's Wall Street Week.
That's right.
Back in the mid '90s. So this is like Wall Street Week revisited for me. So thank you very much for having me on.
Thanks, Phil. Hey, if you've got a question or a comment about the show, we would love to hear from you. Make it concise, make it pithy, and write us. And notice the new email address at andre@benacapital.com. So let's look at the market heading into the information for next week. But first, what was the first movie to make over $1 billion at the box office that won 11 Oscars on this day? We've got the answer in just a moment. Well, what was the first movie to make over $1 billion at the box office that won 11 Oscars on this day? Titanic. In 1998, the film's worldwide gross was over $1.8 billion, becoming the highest grossing movie of all time, on this day winning 11 Oscars. But actually none going to its two stars, Kate Winslet and Leonardo DiCaprio. That night, Leo may not have gone home with an Oscar, but I bet he went home with maybe Giselle or a Heather or a Tiffany. And finally, for our wrap up on Wall Street, a major closing of Foot Locker stores, closing 400 low-performing stores, mostly in the malls. Technology and consulting company Accenture is cutting 19,000 jobs due to a slowing of the economy. Walmart said that they're going to be laying off hundreds at their e-commerce facility because of slower sales. And don't forget, add to that Amazon, they announced at the beginning of this week that they're going to be cutting an additional 9,000 jobs. Apple is moving deeper into Apple TV to produce movies. Apple plans to spend $1 billion a year on producing movies to also show on their Apple TV. Well, the next time you go to a Starbucks, that barista who makes your double cappuccino latte with soy milk, well, he just might also be the CEO of the company. The new CEO of Starbucks, Laxman Narasimhan, said he will be working shifts at Starbucks cafes once a month. Stay tuned. Walt Disney World in Orlando has reached a tentative contract deal to pay workers a minimum wage of $18 per hour. And the New York Yankees are once again baseball's most valuable team. Forbes magazine estimates their value now to be $7.1 billion. That's an 18% increase since last year. And if you live in California, a new bill by their legislature introduced to prohibit the sale of certain chemicals that are used in candy, such as Skittles or Ding Dongs, as well as other of those non-nutritious snacks. So if you have loved ones that still may be in California, you might be sending them care packages of Skittles and Ding Dongs. I guess because of those chemicals, Skittles and Ding Dongs, that's why they have a shelf life like of 50 years. Well, that's a wrap-up on Wall Street Wrap-Up. Join me next week when my guest is going to be the associate editor of Barron's, Andrew Barry. In fact, Andrew wrote the cover story for this week's Barron's. Banks survived another week, and the biggest ones look even like winners. That's next week. Associate editor of Barron's, Andrew Barry. And that's our show for this Friday, March 24th, 2023. My thanks so much to Phil Orlando from Federated Hermes for joining us tonight, but especially want to thank you for allowing us into your homes this evening. Have a great weekend, a fun weekend ahead with the ones you love, and a productive week ahead. I'll see you next week. Remember, if it is Friday, it's Wall Street Wrap-Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.